Thank you very much, Claire. Time to talk about your money, Money Tuesday. And when the stock market nears all-time highs like we're seeing right now, a lot of folks who may have 401ks might get a little nervous because, what goes up must come down, as the song once said. When it comes to stocks, there are ups and downs, but the market as a whole tends to go up over time. Stewart Welch with the Welch Group joins us to talk about this. Give us some perspective this morning. Stewart, good to see you this morning.
Good morning, Mike. Well, we have the fright of Halloween behind us, but people are still frightened about the stock market, particularly since it crossed an all-time high. The Dow did yesterday at 36,000.
Crazy.
So that always gives people pause. And Mike, I can remember talking to you years ago. Is this thing going to cross 10,000?
It wasn't that long ago, Stewart.
It wasn't that long ago, but yeah, it was. It was a number of years ago.
Yeah.
But the market tends to move up over time, and so even though you're frightened, there's some things that you should do. You should set up some patterns for yourself, and let's talk about those.
And Stewart, that really depends on where you are in terms of age and how close to retirement. So set that up for folks.
Yeah, so I think let's start with now is a good time to review your investments. A lot of times people don't look at them very often, but you should look at them at least once a year, maybe more often, but not every day. And but look at them and make sure, like right now, the market's the market's up, the Dow's up about 18%. Take a minute, look at your portfolio. Be sure you're happy with your allocation between, say, stocks and bonds, and then among your stocks, be happy with the stocks that you're in or the mutual funds that you're in. So I would start there, and then second, I think you want to invest in stocks for the long term. So the stock market has produced returns over time of around 9% or higher.
Right.
So you want to count on that, and that is because the capitalistic system of America is working. And so focus on that.
Now, on that second point, the long-term strategy there, if you're under the age of what?
Yeah, so the further you are away from retiring, the more you want to have an allocation to stocks. So as you get into, say, 10 years, 5 to 10 years before, you want to begin to increase your allocation to fixed income. And it kind of leads into the third point, which is to protect your cash flow. So particularly if you're retired, you want to be sure that you protect your bill-paying ability. So you don't want to be paying bills out of stocks that are down significantly. So you're going to use a source of either maybe you've got Social Security that's enough or a pension that's enough. If not, you need to have investments in money markets, CDs, bonds that you can go to pay bills for at least I would say at least a 3 to 5 year period of time.
All right, now sort of for the last point, explain to folks what you mean by maintaining a periodic rebalancing strategy.
Yeah, Mike, this is kind of the secret sauce. So if you started the year with a 60-40 allocation, 60% stocks, 40% bonds, what's happened now is that allocation has gotten out of whack. It's actually going to be heavy on the stock side. So rebalancing forces you to take some profits and put it back in the fixed income category. It's kind of like rebuilding your dry wood. If the market went the other way, it would actually force you to take some money out of fixed income, invest in stocks while they are down. So a really good strategy, and again, that's kind of the secret sauce. We would recommend that you do that a minimum of once a year. We usually wait about 12 months in a day so that if we're taking gains, that we're taking those as long-term capital gains.
And just to be clear, Stewart, if you make that rebalancing, what would the percentage be, or what should it look like?
Yeah, it depends on you. It depends on what your allocation is. But if you started with a 60-40, you're going to go back to a 60-40. If you started with an 80-20, you're going to go back to an 80-20. And again, it just kind of forces you to do things in the right way. And I think I would close with, when in Halloween, when things get scary, most people run. But in the market, when things get scary, you don't run, you invest. That's the takeaway.
All right, Stewart, we appreciate all the information on the strategy.
Thank you, Mike.
Stewart Welch from the Welch Group. All right.